Hi everybody, Ken Heinz here, HFR President with the HFR 500 June 22 Performance Snapshot. This is the snapshot not only for June, but for the first half of 22, which has been an extremely volatile time in financial market performance. Overall, what you'll see is the HFR 500 declined 2.6% in the month of June. That compared to a decline of nearly 9% for the NASDAQ composite, and obviously other U.S. equities declined in a similar manner. And for the first half of the year, decline of 4%. Again, I'll show that the NASDAQ composite lost nearly 30%, other U.S. equities in the 20% range. A couple of things that are, I think, are real important takeaways. Obviously, we all know how volatile the first half's been. Russia invasion of Ukraine, beginning parts of inflation, that accelerated to be 9% inflation here as we're sitting in the middle part of the year. Rising interest rates and the increased likelihood of a U.S. recession all contributed to a challenging environment. Despite that, macro hedge funds posted a gain of over 14%. Other hedge fund strategies also preserved capital, and we'll go through all that as we go through the slides. The important things to take away, though, we've already talked about performance. Approximately 50% of all hedge funds were positive for the first half of the year, which I think is exciting. I also showed that the outperformance of hedge funds over equity markets is the highest that it's been since inception. And finally, I'm very pleased to announce that the Aberdeen HFR 500 Tracker Fund is officially live. It went live July 1st, so it's now possible to invest in a fund which tracks the performance of the HFR 500 index. I put together this slide to show a good synopsis of the first half of 2022. You can see that other than oil, everything that was in the black, or in this case in the green, was hedge fund performance, led by macro commodity, macro CTA, macro overall, the fund of funds risk mitigation index, and then other hedge fund strategies, higher beta strategies certainly declined much less than what you see here, equity market indices. And we'll talk a little bit more about that as we go to the specific slides on hedge fund performance. This slide illustrates the third point that I was referring to at the very beginning, which is that the outperformance of hedge funds over equity market declines in the first half of 2022 is the highest outperformance that we have seen in the first half of the year ever since inception. And so we show that here. The lines are the HFRI macro over the S&P, the HFRI 500 macro over the NASDAQ, the HFR 500 composite over the S&P, and the HFR 500 composite over the NASDAQ. In each of those cases, all four of those cases, the outperformance of the two hedge fund indices over the two equity market indices are the highest that we have ever seen since inception. So I think that's important. It really talks about, even though you've seen a volatile market environment, you are seeing capital preservation, and that's why institutions invest in hedge funds in 2022 now. Taking a quick look of June performance at the main strategy level, you see here that working from the decline of the NASDAQ, and again, that's down 8.7, the S&P and the Dow are also down sharply. And you see here that the HFR 500 macro posted a narrow gain. Again, it's not a lot, only 5 basis points, but that was overall a good first half for macro hedge funds, and overall they outperformed equity market declines by a significant amount. You can see here fixed income based relative value declined about 2%, 2.6 for the overall composite, and the higher beta strategies, event driven and equity hedge, were down a little over 4, which again is less than half of the equity market declines that we saw in the month of June. Going one level deeper, you see here the top sub-strategy areas of performance in the month of June. Actually, the highest is an equity sub-strategy. It's healthcare. That gained 2.9%. The relative value volatility, which is funds that trade volatility as an asset class, gained 1.2%. And obviously, there was a tremendous amount of volatility in the month of June, as there was throughout the first half of the year. Another equity sub-strategy, quantitative directional, this can be both long and short based on quantitative methodologies, gained 1.1%, and then 1.1% gain for the HFR 500 macro systematic diversified. We've talked about that index a lot in the first half of the year because it has had such strong performance. These are quantitative trend following strategies in liquid markets, and these have done extremely well in the first half of the year. Again, that's interesting because those models did very well despite the breakdown in historical correlation between equities and bonds, which was so important in the first half of the year and had such an impact on long-only portfolios and 60-40 portfolios. All of that very well referenced here. Taking a longer view of time and looking at the very volatile first half of the year, you can see that the macro hedge funds have done well. There's been a consistent theme throughout the year for sure. In all of these videos that we've recorded, you see HFR 500 macro gain 14.2%. The other sub-strategy that has done a very good job of preserving capital is those of the fixed income multi-strategies, the HFR 500 relative value index. Small decline there of about 0.2%, and all of that is actually in the month of June. It was down 2%, so it would have been up about 1.3% for the first 5 months of the year. Overall, the composite decline of 4%, and again, I compare that to equity market declines that we show the NASDAQ here of 29.5%, but the S&P was down around 20% as well, and you see higher beta strategies, event-driven and equity hedge down 9% and close to 13% for the more volatile, higher beta strategies for the first half of the year. Drilling one level deeper into the top sub-strategy areas of performance over the first half of the year, these really haven't changed very much as far as that goes. The commodity index has been the leader of performance, 34% gain in the first half of the year, as obviously inflationary pressures, higher interest rates, and the fear of a recession, as well as a lot of the supply chain constraints, have all driven up those strategies. A gain of nearly 19% for CTAs, that's the HFR 500 macro systematic diversified index, 11.8% for the gain for energy basic materials. Obviously that has a lot of the same commodity exposures that are in the commodity index, but those are really equities of companies that are engaged in the energy production and base materials, drilling, things like this. And then finally, not surprisingly, a gain of 9 and 2/3% for the relative value volatility index. These are similar to CTAs, but a little bit different. These are ones that primarily trade options, and as we say, they trade volatility as an asset class. All of those well ahead of the gains of equity, of the declines of equity markets for the first half of the year. I mentioned at the outset, we're very excited to be able to announce or to convey that the Aberdeen HFR 500 tracker funds are officially live for July 1st. So it's now possible to invest in a fund that tracks the performance of the HFR 500 index. If you have any questions about this at all, we have a lot of material on our website. Please feel free to reach out to me directly. I can help you. Understand the material if you have answer questions you have, and I can also put you in touch with contacts at Aberdeen if you have specific questions about the tracking fund. As you know, if you've watched this video and you've watched some of the other ones that we've done, we have a lot of great information on our website, so please feel free to visit that. First off, if you're watching this video, you know we do regular performance updates on YouTube. Please subscribe to the channel. And one of the things I want to emphasize here is very important is we're communicating information on hedge fund performance. We want people to understand and appreciate that. If you have questions, please feel free to send them to us. You can send them via email. You can send them over any of the social media platforms that we publish information. We've got people that are looking at all of those, and so please come back to us with questions that you may have about hedge fund performance or the way any of the indices work. We're happy to answer those. When you do go to the website, www.hfr.com, please, a couple of links that I want to make sure that you do visit. Download and read the Investor Guidebook. This is something that we've prepared that really talks about how the HFR 500 index is a solution to common benchmarking problems that a lot of institutions have, in 2022, and I want you to look at that. It really talks about how it's much superior to a number of different benchmark things, such as theoretical benchmarks. A lot of people benchmark to LIBOR plus 200 and things like that. Those are very arbitrary and very difficult when performance materializes to be significantly different, higher or lower than those benchmarks. Also, please feel free to check out the HFR 500 YouTube video. It's on this same channel, and it talks a lot about the HFR 500 as a solution to common benchmarking challenges institutions face. Finally, please feel free to reach out to me, Ken Heinz. If you have questions, like set up a call, you can email me at hfr500@hfr.com. You can email me at my own address or at indices@hfr.com. We have if you have a regular contact at HFR that you work with for any of our licensing, that person can also help put you in touch with me to understand everything that you need to know about hedge fund performance and specifically about the HFR 500. Thanks again, and I look forward to speaking with you again next month.